Well, you know what they say, don't you? That everything is bigger in Texas, including the windstorms. Man, is it windy here today. I'm already gonna let you know in advance, guys. There's gonna be some strong wind gusts on this walk. I'm trying to avoid it as much as possible, but it's here. I'll tell you one thing that's not bigger in Texas is the home prices, because this neighborhood we're walking through has homes for sale anywhere between $250,000 to $400,000, which is not bad at all. And I can see why a lot of people move here, because it looks clean, safe, you get a nice big house, and weather's pretty decent today other than the wind, but it's like 78 degrees out. So not bad at all, guys. And we're in Amarillo, Texas today. But the real estate market's gonna have to take a back seat today to inflation, because the latest inflation report came out and it's not good, okay? Because we are still at 3.7% inflation year over year as of the September reading, which is exactly where we were at in August. So inflation is not budging, guys. In other words, the Fed's monetary policy is not working anymore. It seemed like it was working pretty good for a while there, going from 9% all the way down to 3.2% before it started going back up. But now we've had a couple of months in a row where inflation is continuing to go back up. And as far as I'm concerned, having it stay flat and not go up or down is basically the same as it going up, because it still means prices on everything are 3.7% higher than they were a year ago, and that's not good for your wallet. And the funny thing about all of this is that the Fed's economists, they're predicting no recession, low inflation, and flat unemployment. Basically anticipating the perfect soft landing and Goldilocks scenario that they've all been wishing for. They're saying now that that's going to happen. But yet we just got this recent inflation reading saying that it's not going to happen because inflation is still running too hot. And the funny thing about this is they're predicting this Goldilocks scenario, but literally in the same prediction in the Fed's minutes, they said that we're not going to reach 2% inflation until about 3 years from now, guys. 3 years from now. So that means the Fed is going to have to keep interest rates higher for a lot longer than they originally anticipated, but somehow we're going to reach this magical scenario where there's going to be no recession. I mean, having prices stabilized to 2% somewhere between 2024 and 2026 is not a soft landing, if you ask me. And I'm not an economist, I'm just an average person that has to pay for things just like the rest of us do, and having everything continually get expensive month over month, year over year is not a soft landing. And you know, I've been trying to think about what type of tools does the Fed have in their toolbox left in order to basically postpone this recession past election date? Because that's one thing that a lot of people are thinking, that, you know, this recession is just not going to happen until after the election, which very well may be true. There needs to be more bullets in the gun in order for them to be able to delay the recession. Well, they've already hiked interest rates, so they're probably not going to be hiking them a whole lot further. And then we're probably going to see inflation spike even higher, so that's not going to work. So what's left? Well, I've been scratching my head over this one for a while, but now I think I know. And what I think it is it's all these feel-good news stories that are coming out, just like this one, saying that we're going to hit this perfect landing scenario and that everything's going to be fine. And I think the more that narrative is pushed, the more stories that come out like that, and the more people hear that and read that, the more people will start to believe it, and then it will essentially come true, or at least that's what they hope will happen. But I don't think that hope and joy is going to be the answer to this one. I just don't think that, you know, positive energy is going to help us dodge this recession. Maybe, guys. I'm a firm believer in keeping a positive mindset and you know, attracting positive things in your life. But in this scenario, I'm not sure if just thoughts can actually turn into things when it comes to this economy. Because another thing that they keep quoting in these feel-good news stories is how consumer spending and business spending have been more resilient than they initially expected. Well, yeah, that's because inflation is still going up, guys. Like, I don't understand how people don't make this connection that the spending is going up because everything costs more. So if things were going down in price, then spending would probably be going down as well, because people won't be spending as much because they don't have to. But right now, everybody, including businesses, have to spend more just to pay the bills, just to keep the shelves stocked, just to keep the lights on at your house, just to keep the car in the garage. just to keep the roof over your head, and so on and so forth. So basically, this latest inflation reading is not going in the right direction for any of us, including the Fed, and it's going to be interesting to see what stance they're going to take on this. And you know, I almost think it doesn't really matter if they raise rates again this year or not, like they're talking about. It's only 25 basis points, because the real pain, I think, is going to be felt from what Jerome Powell mentioned earlier this year, that it's not so much about what the rates are, it's about them keeping the rates higher for longer. So the higher they keep these rates for longer, the more damage it will essentially do to the economy, and we'll start feeling more and more pain over time. And you know, the biggest problem with this inflation report is, once again, the things that are most essential to our daily lives, food, gas, housing, are the things that are driving inflation the most. I think they're really out of bullets, guys. I really do think that there's nothing they're going to be able to do to dodge this recession. So all they can do at this point is come out with positive narrative stories to try and convince as many people as they can that that's what's going to happen. So that way people continue to spend, because the spending, like they keep mentioning, is still up, and that's 80% of our GDP. So as soon as the spending starts to disappear, that's when we're going to start seeing real problems in the economy. You're going to see a lot more layoffs, and that's when the pain really begins, if you ask me. And what's interesting is, if you take a look at this inflation chart here, going all the way back to 1970, you can see the rise and fall in inflation that we've had in this country. And almost every single time there's been a big spike in inflation, and then it starts coming back down, you can see it goes back up. And I've mentioned to you guys before on the channel that rent is starting to come down by a minuscule amount. It has been dropping month over month for the past several months, but we're talking in the magnitude of like $6-7 a month that is dropping. It's not like it's dropping by $100 a month every single month, and all of a sudden rent's going to become affordable. Gas is going to continually be a huge problem. We're starting to see it go back to close to $100 a barrel again, and the gas index in September was up 2.1%, and in August it was up 10.6%. And core inflation, which is what they look at, and they basically extract all the things that actually matter from that, food and energy, out of there. So that really makes a lot of sense. But yeah, they look at core inflation, and core inflation didn't move either. So core inflation, even when they remove food and energy, which are supposedly volatile categories, is why they don't include it, even though it's the things that we need the most, it's still not going down. You also have car insurance and the cost of new cars continuing to rise. And I've been covering different insurance stories with you guys. Every type of insurance is up right now. Car insurance, homeowners insurance, health insurance, life insurance, pet insurance, you name it, guys. Insurance is up. And you got things like rent, groceries, and gas, which are the most essential items, are continuing to move higher and faster than expected. And so some people might be wondering, why haven't we had the recession yet then, if all this is such bad news, Michael? Well, I'm not an expert, but my opinion on that is because that people still have the money to spend, at least for now. Maybe not for very much longer, but when you look at some of the trends that we have seen, and since so much of this make-believe is all based on consumer spending, people had the money, guys, for a long time. You know, the savings rate is now starting to dwindle back down to pre-pandemic levels, but earlier in the year, it was still higher than pre-pandemic levels. So people still had money left over from that. And then we saw credit card debt hit an all-time high at $1 trillion, which is a record that we've never seen before. That helps people continue to keep spending. And then we also see more home equity loans and more home equity lines of credit being made in the last year than we've seen in the past 15 years. So to me, when you combine all of those things, that has helped us not have a recession. And it basically all just boils down to that. It boils down to the fact that people still had the money to spend. But that's going to come to an end at some point. At some point, people won't have the equity to spend from their homes. At some point, the credit cards will be maxed out, and maybe I can't pay that bill anymore. At some point, people won't be able to get new credit extended to them because they already have too much debt and their credit score is starting to go down. And at some point, the pandemic savings is going to run out, which is probably going to be sometime at the end of this year. That's my opinion on why we haven't seen a true recession yet. But let's not forget, guys, that last year we saw 2 down quarters of GDP, and they didn't call it a recession, even though it should have been called back then. But because inflation has been such a huge problem, it's helped keep consumer spending higher than it should be, which makes it look like we're not in a recession. So that's my theory on that. If you guys have any other opinions on it, let me know in the comments. And as you guys know, I'm still out on the road, so it's been basically impossible for me to get to the comments lately, just because I'm planning these videos, guys. I'm out shooting them, I'm editing them, I'm driving 5-6 hours a day. I have to get to the hotel, edit the videos, have dinner. Like, it's a lot of stuff to do in one day. So if I don't answer your comments, please don't think it's not because I don't want to. It's just because I'm just so short on time, and I'm only one guy right now. But hopefully when I get back in Miami, things will be more settled down for me. And also, the other thing is, guys, about this recession real quick before we move on to something else, is that there's also these stories that they keep putting out that, you know, consumers are still spending big money on vacations, concerts, and dining out. Businesses are still hiring. The jobs report came in, 336,000 jobs last month, until that gets revised down, as it keeps continually getting revised down. So we keep hearing all these stories too, like I mentioned earlier, that makes it look like there's no recession. And of course people are spending money on vacations and concerts and all of this because everybody was locked inside for 2 years, and they're using the last little bit of their savings and money they have left to be able to do all this stuff before they can't do it at all anymore. Again, not because of lockdowns, but because they'll be broke. So that's my theory on that as well. And as far as the jobs go, well, we already know that a lot of those jobs are low-wage jobs that can't pay the bills, and people need 2 or 3 of those jobs just to be able to make a living. So that's not very helpful either. And you don't have to go any further than the trucking industry to be able to determine that we are in this recession, because they actually talked to a trucker. He's the president of Cleveland Express Trucking, and he said that the end of the year is usually their busiest time of the year due to the holidays. He said there's been just a small bump, but far below normal this year. On top of that, they have to fight tire costs, because obviously tires is something they constantly need in the trucking business. Those are way up. Fuel prices obviously are out of this world. That make trucking more expensive and less lucrative. He also wanted to order a few new semis in order to have some backup trucks, because trucks break down, trucks need repairs, and sometimes they're just out of service for a little while. And he's waiting to do that as well because there's so much volatility. You know, to buy these trucks is very expensive, and buying them at the wrong time, like now, could potentially put the company out of business. So you see a lot of things like that happening, and the trucking business is the lifeblood of this country, guys. That and the railroads, if it wasn't for those guys, we wouldn't be able to get anything that we normally see. Oh, you want to have stuff Amazon the next day? Guess what? It's not going to happen because the trucking business is dead, or because the railroad's not working. I kid you not, there are far more semis on this I-40 that I'm traveling along than there are cars and trucks. In fact, if it wasn't for the semis, there'd be almost nobody on the road, guys. I'm not even kidding you. And then I saw a huge train just a couple days ago pulling almost nothing but Walmart and Amazon containers. That's all of our crap that we buy, the cheap stuff imported from China, and without them, you're not going to have that. So next time you get annoyed by stopping at a railroad crossing, or annoyed because a big semi is going too slow, just remember that if it wasn't for them, you wouldn't be able to get any of your next day delivery stuff. They're the ones that make your life easy, okay? Now let's talk a little bit about real estate, which is what we normally do on this channel. Zillow came out with a new story today talking about how the competition in the housing market is cooling down tremendously. At the same time, sellers are cutting prices, and we're starting to see supply inch back up. And this is exactly what I've been saying for about the past week and a half or so. And basically what we're seeing right now is, because mortgage rates are over 8% for the vast majority of borrowers, that's pretty much taking whatever's left, whatever juice is left in the housing market out of it, because it's just too unaffordable, guys. And it's almost like it doesn't even matter if mortgage rates go to 9% or 10% from here, because the 8% range is already crushing demand so much that it's like it doesn't matter anymore. Now here we have a house for sale, 3-bedroom, 3-bath, 2,700 square feet. So a pretty large home, very nice and remodeled, but here's the problem. It's been on the market for a little over 3 months now, They've already had their first price cut, which was not very significant, only $10,000, and this house is well above the median home price of the area, which to me is why I suspect it's not selling. And once again, we have this hidden data here on Redfin, so we don't know what the previous owner paid for the home. I'll tell you what's the one thing that would scare me away from Texas. Oh man, that property tax bill. Look at that. For 2023, property tax bills almost $6,600 for a house that's 350 grand. That is crazy. Now, once again, don't get me wrong, this doesn't mean that nothing's selling, nothing is moving, because I've shown you guys different examples of both here on the channel of homes that have been sitting on the market for too long with big price cuts. At the same time, we're seeing other ones that fly off the shelf within a matter of weeks. So it really just depends. But the other interesting thing that Zillow noted in their story here is how we all thought that nobody would sell because we have too many people that have 3% interest rates or rates that are below 5%. Well, it's getting to the point where some people can't afford to wait any longer because a lot of people were sold the lie that by the end of this year, interest rates would be lower than they were at the beginning of the year. And that in fact ended up being totally not true. So even though new listings are down by 6%, the amount of total listings is up by 0.2%, which is what I've been showing you guys, that the amount of homes sitting on the market is inching up. It's inching up little by little because the buyers aren't there to absorb the current supply. And that's what I think you're going to continue to see throughout next year. You're going to continue to see the supply just build and build because the interest rates are too high, so it makes the homes unaffordable for the vast majority of people, and there's still people that need/want to sell, and you're going to see more new listings continue to hit the market, but not enough people come online to be able to buy them. And according to Redfin right now, we've seen the amount of listings on the market go up by 2% just since September, guys. So the numbers, once again, never are the same. You have Zillow saying it only inched up 0.2%, Redfin saying it's up by a full 2 percentage points. So my guess is it's probably somewhere in the middle. This is telling the true picture of this housing market, that unaffordability has finally reached maximum velocity and is probably going to continue to spiral out of control, because the rates are likely to continue to go up. And if you're wondering why interest rates will continue to go up, even if the Fed does nothing and just keeps interest rates the same, it's because the Treasury yields are likely to continue to climb in this environment, guys. When we have this amount of inflation, all the investors that invest in treasuries want a higher return because the risk is higher, and therefore it pushes the yields up on the bonds, and the mortgage rates go hand in hand with the 10-year treasury. So the higher that moves, the higher we're going to see mortgage rates go. Now, since we're here in Amarillo, let's talk about the market here real quick. Just like everywhere else, home prices here have gotten out of control compared to where it was pre-pandemic. And even though it's still very affordable here, median home price here is still $226,000, guys. So not bad at all when you're looking at it on a national scale. But pre-pandemic, the median home price was more like 150 grand. So it's still up far beyond where it was before then, and I'm sure the locals that live here and actually need to buy these houses can feel that pain. And we know that just by looking at the amount of homes that have been selling year over year is down almost 15% according to Redfin. High interest rates even affect the lower cost markets as well, as we can see here from this report. And according to the ReVenture app, Amarillo, Texas is about 20% overvalued. So not nearly as bad as some of the last couple places we were at in Flagstaff and Albuquerque, but still 20% is a significant overvaluation of a home. And if you look at the last few months, pretty much home prices here have been remaining relatively flat in Amarillo, and it's probably going to continue like that because here's another thing. Inventory here continues to rise. In fact, inventory is already at 66% of where it was pre-pandemic, and as that number continues to inch up, you're going to see more price cuts and you're going to see more pressure on sellers because there's too many homes on the market for sale and not enough people out there to buy them. Because the reality is, it doesn't matter that the median home price is $224,000 here if people still can't afford the monthly payment at an 8% or 8.5% interest rate. But I'll tell you what, guys, this is definitely one of the nicer areas I've been to in terms of what you can get for the money. I mean, this is a very nice neighborhood we're walking through, and the fact that homes here are well below the $400,000 price point in many cases is not bad. And there's a lot of things close by. There's lots of shopping, lots of restaurants and stuff. And I don't know what else there is to do around here, but I'm sure the locals know and they can see the value in it. And there's definitely value in having a nice and safe, clean neighborhood as well. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.